$27,600. That's what $100 a month turns into over 10 years. But here's what nobody tells you. One single decision at the start determines whether you get $27,000 or only $14,000. Stay with me. $17,308. This is a clear and interesting number. A used car, a significant down payment on a larger purchase, a robust emergency fund. It is the potential outcome of a simple, consistent action. Investing $100 every single month for 10 years, assuming a 7% average annual return. Many people might see this figure and think about the investment choices or the market conditions that led to it. However, the most critical decision that shapes this outcome is often overlooked. It is not about picking the perfect stock or timing the market. The single most impactful choice is simply deciding when to begin the journey. Imagine you have a tiny seed. You plant it in a small pot with nutrient-rich soil. This seed represents your initial investment, that first $100. It looks small at first. You commit to watering it a little bit each week. At first, changes are almost invisible. You might not see visible progress and could be discouraged. But beneath the surface, roots are forming. After months of care, a small green sprout pushes through the soil. This is your first bit of interest, a return. The plant is fragile but now living and growing. Continued weekly watering makes it stronger. It grows more leaves. These leaves capture more sunlight, speeding growth. This is compounding. You keep adding $100 per month, like water. Growth comes from both your water and the plant's increasing size. Your total contribution. Before we dive into the different growth scenarios, it is essential to establish a clear baseline. This baseline is the total amount you personally contribute from your own pocket. Understanding this number is crucial. It shows how much of your final balance comes from your savings and how much comes from investment growth. In our example, the plan is simple and consistent. You commit to setting aside $100 every single month. You do this without fail for 10 years straight. 12 months multiplied by 10 years equals 120 payments. 120 payments of $100 each. $100 multiplied by 120 equals $12,000. Reveal. Your total contribution, $12,000. This is your principle, the foundation for all growth. In this example, we assume you place your $100 each month into a very safe investment vehicle. High-yield savings account, certificate of deposit, very low-risk government bond fund. These investments are known for their stability and low volatility. The trade-off for this safety is a lower rate of return. We'll assume an average annual return of 3%. You contribute $100 every month for 120 months. With 3% compounding, your money grows slowly but steadily. After 10 years, the final balance is approximately $13,972. You put in $12,000, growth, interest is $1,972. This path suits very low risk tolerance or money you might need sooner. The primary goal is preservation with small growth. In our analogy, it's a small shrub, not a towering tree. Now let's explore a more moderate and historically common scenario. This approach involves investing your $100 per month into a diversified portfolio, such as a low-cost global stock market index fund. These funds hold a wide variety of stocks, spreading your risk across many companies and industries. While they fluctuate, they have historically provided higher returns over long periods. For this scenario, we will use an average annual return of 7%. Your commitment remains the same, $100 per month for 10 years. The 7% annual return makes compounding more pronounced. Each year's interest is larger and reinvested. After 10 years, your investment would total approximately $17,308. That's $5,308 in growth, more than 2.5 times the growth of the 3% path. Same savings habit, different vehicle and return. A balanced approach can reward patient investors over a long horizon. The plant has grown into a healthy, medium-sized tree. For our final scenario, we will consider a more optimistic, high-growth outlook. This could reflect strong market performance or focus on high-growth sectors such as technology. Achieving 10% over a decade is possible, but usually with higher risk and greater volatility. The plan remains unchanged, $100 per month for 10 years. With a 10% annual return, compounding becomes truly powerful, especially in later years. Your final balance would reach approximately $20,055. From $12,000 in contributions, that's $8,055 in growth. Side by side, 3% leads to $13,972, 7% to $17,308, 10% to $20,055. Same $12,000 in discipline, different outcomes based on return, captured clearly in one chart. But there's a factor even more powerful than return: time, and the cost of delaying your start. We have seen how different rates of return can change your outcome. Now, let's examine the impact of a different choice: the decision to wait. Imagine it is today, May 15, 2026, and you think, I'll start this 100-month plan later. I'll get to it in a few years. Let's say later means you wait exactly 5 years, beginning in May 2031. Split screen. Investor A starts 2026. Investor B starts 2031. Red X marks 5 years missed growth. You still commit to the same plan, 100-month for 10 years. You're as disciplined, but your timeline is shifted. Use 7% average annual return. Investor A. Invest 2026, 2036. At 10 years, they have the 17E308. Investor B. Invest 2031, 2041. At their 10 years, they also reach 17.3A. Crucial point. In 2041, the early starter has been invested 15 years. That initial $17,308 had another 5 years to grow. Look at 2036, the 10-year mark for the early starter. Investor A has $17,308. Investor B, only 5 years in. After 5 years of contributing $100 a month at 7%, Investor B would have approximately $7,162. That's less than half of what Investor A has accumulated. Early starter is ahead by over $10,000, not because they invested more money, but simply because they started sooner. To reach $17,308 in 5 years, Investor B would have needed closer to $240 per month. This is the cost of procrastination. Time is a non-renewable resource in investing. Understanding these concepts is the first step, but putting them into practice is what creates results. The process does not need to be complicated. Simplicity, consistency. The most important action is to start now. Starting with $25 a month is infinitely better than waiting to start with $100. Make it automatic. Schedule it for the day after you get paid. If you accept long-term risk, consider low-cost, broadly diversified index funds. Keep a separate emergency fund covering 3 to 6 months of essentials. Resist daily checking. Review once a year. Patience is key. The conclusion is simple and inescapable. While return matters, time is the most dominant force of all. The difference between a small pot and a substantial asset often comes down to when you begin. Growth isn't linear, it's exponential. Late gains rest on early foundations. Compound interest only recognizes your principal, the rate, and the time, and time has the most dramatic effect. The journey to financial well-being begins with your first $100. Do not be discouraged early. Be patient. Be steady. The most powerful action is the one you take right now. Start today. If you found this breakdown helpful, subscribe for weekly personal finance insights, explained in plain English.